Welcome to our deep dive into The Simple Path to Wealth by J.L. Collins.
Oh, yes.
Personal finance can feel pretty overwhelming sometimes,
It really can.
but hopefully we can help you navigate it a little bit today.
Absolutely.
We'll be uncovering the key strategies J.L. Collins used to retire a millionaire by 62,
Wow.
and we'll explore how someone with zero experience ended up owning a hotel in Tahiti.
Really?
Plus, we'll unpack the surprising financial downfall of Mike Tyson, despite his boxing fortune.
Yeah.
Along the way, we'll demystify FU money and why it's about so much more than just, being rich.
It's about the freedom to make choices
Yeah,
based on your values, not just your bank balance.
I love that idea. So it's
Yeah.
not about being reckless or anything, but it's
Mhm.
having that security
Yeah.
to be able to walk away from situations that don't align with your goals.
Yeah, absolutely.
Speaking of which, J.L. Collins tells a story about negotiating extra vacation time using his FU money.
Oh, interesting.
Back then, it was a modest $5,000, but it gave him the leverage to say, hey, I'm happy here, but I also value exploring the world.
I see.
If you can't give me the time off, I'll find a way to make it happen.
So did his employer grant him the time off?
They did. And not only that,
Oh, yeah.
he negotiated an extra month of vacation going forward.
Really?
Yeah, it's a reminder that so many things in life are actually negotiable,
Right.
especially when you're not financially beholden to that specific situation or job.
Right. Yeah.
But FU, money goes beyond just quitting a job. Right?
Oh, absolutely. Think about the emotional benefits.
Yeah.
Imagine waking up every day without that financial anxiety,
Right.
without that knot in your stomach.
Yeah.
It's about pursuing your passions, taking calculated risks,
Yeah.
maybe starting that business you've always dreamed of
Right.
without the fear of financial ruin.
I see.
FU.
Mon-
Money allows you to really prioritize your well-being
right.
and pursue opportunities that align with your values, not just your paycheck.
That resonates with me, especially the reduced stress part.
Yeah. But before we get too carried away with the joys of FU money,
Yeah.
we need to address the elephant in the room. Debt.
Oh, yeah.
The U.S. is dealing with a staggering $12 trillion debt burden.
Wow, that's a lot.
J.L. Collins highlights how mortgages, student loans, and consumer debt are keeping people trapped
Yeah.
in this cycle of financial dependence.
It's a shackle, really,
Yeah.
that goes beyond just the financial strain.
Right.
Think about the mental burden of debt.
Right.
It can really limit your options, fuel anxiety, and lead to even destructive behaviors. It's like this weight dragging you down,
Right.
preventing you from really reaching your full potential.
So how do we break free from these debt shackles?
Well, J.L. Collins offers some insights.
Okay.
He suggests a pretty practical approach.
Okay.
If the interest on your debt is 5% or less,
Okay.
weigh it against your potential investment returns.
I see.
But if it's over 5%,
Yeah.
prioritize paying it off as aggressively as possible.
That high interest is like a leak in your ship.
Oh, okay.
You need to plug it before you set sail for wealth building.
That's a really helpful rule of thumb,
Yeah.
especially for those of us who are juggling multiple debts.
It can get tricky.
But what about good debt? We hear that term all the time.
Ah, yes.
What's the deal with that?
That's a myth we need to debunk.
Okay.
While certain types of debt, like a mortgage or a business loan,
Yeah,
can be leveraged strategically,
right.
all debt carries inherent risk.
Yeah.
Take student loans, for instance.
Okay.
J.L. Collins points out the alarming rise in college costs.
Oh,
His
Yeah.
own education at the University of Illinois,
okay.
back in the late 60s and early 70s, cost about $1,200 a year.
Wow.
Now fast forward to his daughter's college years.
Okay.
A state school education ran about $40,000 per year.
Wow. That's a huge difference.
That's over 33 times higher.
It's crazy how much it's gone up.
It really is.
And the fact that student loans are notoriously difficult to discharge, even in bankruptcy,
Right.
makes them especially risky.
Precisely.
Yeah.
It's crucial to approach all debt with caution.
Right.
Understanding the potential downsides and the long-term implications.
For sure.
Yeah.
So we've established that debt is a major obstacle to financial freedom.
Right.
And FU money gives us that power to make choices
Yes.
that are aligned with our values.
Uh-huh.
But how do we actually build that financial security?
Yep.
How do
Yeah.
we generate FU money?
That's where investing comes in.
Okay.
And the good news is,
Yeah.
it doesn't have to be complicated.
Okay, good.
J.L. Collins argues that sound investing is surprisingly simple,
Okay.
despite Wall Street's efforts to make it seem like rocket science.
Yeah. They do like to make it sound really complicated, don't they?
They do.
Yeah.
It's all about shifting your mindset
Okay.
from viewing money as something to spend
Yeah.
to something that can work for you
Okay.
to build wealth over time.
I like that. So many people are stuck in that cycle of earning and spending,
Yeah.
never really harnessing the power of their money to work for them.
He breaks it down into 3 levels of thinking about money.
Okay.
The first level is all about buying stuff,
Yeah.
which, let's be honest, is where many of us get caught up.
Right.
The second level is where you start to dip your toes into investing,
Okay.
but maybe not strategically.
Right.
Then there's the third, the most powerful level.
Okay.
This is where you truly understand how investments work,
Yeah.
and you use that knowledge to systematically build wealth.
He uses Mike Tyson as an example of this, right?
Exactly.
A brilliant boxer,
Yeah.
but someone who ended up bankrupt
Right.
despite earning hundreds of millions of dollars.
Tyson was a master of his craft in the ring,
Yes.
but he lacked the financial literacy
Right.
to manage his wealth effectively.
Yeah.
Really highlights that even with incredible talent and success
Right.
in one area of life,
Yeah.
financial literacy is crucial
It really is.
for long-term security and well-being.
Okay, so let's talk about the stock market, which can be a bit intimidating for many.
Oh, yeah.
All the news about market volatility and crashes can make it seem really risky.
Right.
Gambling almost.
Well, it's true. The market experiences short-term fluctuations.
Yeah.
But the key is that it consistently trends upwards over time.
Okay.
Think of it like a roller coaster.
Okay.
There will be dips and turns,
Yeah,
but the overall trajectory is upward.
I see.
If you stay on the ride, you're likely to reach your destination.
So how do we navigate this roller coaster and come out on top?
J.L. Collins strongly advocates for index funds,
Okay.
specifically VTSAX, the Vanguard Total Stock Market Index Fund.
Why VTSX? What makes it stand out?
A couple of key reasons.
Okay.
First, it's incredibly diversified.
Okay.
Investing in VTSAX, you're essentially buying a tiny piece
Yeah.
of nearly every publicly traded company in the U.S.
Oh, wow.
This spreads your risk
Okay.
and allows you to capture the overall growth of the market. Second, and this is crucial, VTSAX has incredibly low fees
Yeah.
compared to actively managed funds.
So you're not paying a high price for someone to pick stocks for you.
Exactly. Research has consistently shown that index funds outperform actively managed funds over the long run.
Really?
Yeah, those high management fees.
Yeah.
And the difficulty of consistently picking winning stocks eat into your returns.
Yeah.
J.L. Collins uses this great analogy.
Okay.
Imagine the actual value of companies,
Yeah.
the underlying businesses, as beer,
Beer. Okay.
solid and substantial. The fluctuating market prices are like the foam on top,
Okay.
all froth and hype.
So we should be focusing on the beer, not the foam.
Precisely. Focus on the long-term value and growth,
Yeah.
not the short-term market noise.
That makes a lot of sense.
Yeah.
But I am curious about the psychological aspect of investing.
Right.
Even with a sound strategy like VTSAX,
Yeah.
it's easy to get caught up in the fear and panic when the market dips.
Absolutely.
Yeah.
You've hit on a critical point.
Yeah. Even when we know market crashes and corrections are normal,
Uh-huh.
those psychological traps can lead to costly mistakes.
Oh, yeah.
Fear leads to panic selling.
Right.
And the allure of market timing can tempt even seasoned investors.
It's like that urge to jump out of a roller coaster when it
Right.
starts going downhill,
Exactly.
even though, it'll climb back up eventually.
That's a great analogy.
Yeah.
Think of market crashes as temporary sales
Okay.
when prices drop.
Yeah.
It's an opportunity to buy more shares at a discount,
Oh, okay.
accelerating your wealth building over time.
So the key is to resist that emotional impulse
Yes,
and trust the long-term upward trend of the market.
exactly. Patience and discipline are your greatest allies in this game.
That's a good point.
And here's another myth to debunk:
Okay.
market timing.
Ah,
J.L. Collins emphasizes that even the so-called experts
right.
can't consistently predict those short-term market swings.
It's basically impossible.
It is, and trying to time the market,
Often leads to buying high and selling low.
right, the exact opposite of what you want.
right.
This is all starting to click.
Good.
So we've got our FU money mindset.
Yes.
We're tackling debt strategically
Mm-hmm.
and embracing the power of index funds like VTSAX.
It's a good foundation.
But how do we actually build a resilient investment portfolio?
Well, J.L. Collins outlines 2 main stages of investing:
Okay.
wealth accumulation and wealth preservation.
Okay.
Each stage is tailored to your life circumstances and goals.
So it's not a one-size-fits-all approach.
Not at all. During the wealth accumulation phase,
Okay.
when you're working, saving, adding to your investments,
Right.
you can afford to take on more risk.
Okay.
You have time to ride out any market downturns.
Yeah.
He recommends sticking with 100% VTSAX during this phase.
So VTSX is our workhorse during the wealth building years.
Exactly.
What about when we transition into the wealth preservation stage?
That's when you might want to add some stability.
Okay.
And that's where bonds come into play. J.L. Collins recommends VBTLX,
Oh, okay.
the Vanguard Total Bond Market Index Fund.
Bonds. I know they're considered safer than stocks, but why are they important?
Think of bonds as the steady eddy of the investment world.
Okay.
They tend to offer a lower rate of return,
Yeah.
but they provide stability and act as a hedge against deflation.
I see.
So while stocks are like the high-growth engine,
Yeah.
bonds act as the shock absorbers,
Okay.
smoothing out the ride during market turbulence.
So it's about finding that balance
Precisely.
between growth and stability.
And the ideal mix will vary,
Mhm.
depending on your risk tolerance, your time horizon, and your goals.
Okay, this is making sense.
Good.
We've got our stock index fund, VTSAX, for growth,
Uh-huh.
and our bond index fund, VBTLX, for stability.
Right.
Now, what about taxes? Are there ways to minimize that burden?
You bet. J.L. Collins emphasizes the importance of utilizing tax-advantaged accounts,
Okay.
like 401k, IRAs, and Roth IRAs.
But there are so many different options.
I know, right?
How do we know which is right for us?
It depends on your circumstances, income level, and goals.
Oh, okay.
Let's start with 401k. Those are employer-sponsored plans.
401ks, those are the ones that often come with employer matching, right?
Exactly.
I
It's
hate
like
them.
getting free money from your employer.
Yeah.
So it's crucial to contribute enough to get that full match.
Right.
With a 401k, you contribute pre-tax dollars.
Okay.
So you get that immediate tax break.
I see.
Plus your investments grow tax deferred.
Okay.
And you only pay taxes when you withdraw in retirement.
So it's like a tax-sheltered account with a potential bonus?
You got it. Now, while 401ks are great,
Yeah.
especially with that employer match,
Yeah.
they tend to have limited investment options.
I see.
That's where IRAs or individual retirement accounts come in.
IRAs offer more flexibility, don't they?
Exactly. You have a wider range of investment choices,
Okay.
allowing you to tailor your portfolio to your needs and preferences.
There are two main types of IRAs, traditional and Roth. Okay, so what's the key difference? They both seem to offer tax advantages.
The difference lies in when you get the tax break.
Okay.
With a traditional IRA, your contributions are tax deductible,
Okay.
meaning you lower your taxable income now.
I see.
Your earnings grow tax deferred,
Okay.
and you pay taxes on withdrawals in retirement.
Got it.
Roth IRAs work a bit differently.
Okay.
Contributions aren't tax deductible,
Okay.
so you don't get that immediate tax break.
Okay.
However, your earnings grow tax-free,
I see.
and qualified withdrawals in retirement are also tax-free.
Wait, tax-free withdrawals in retirement?
It's a pretty significant advantage.
It sounds pretty amazing.
It can be, especially if you anticipate being in a higher tax bracket during retirement.
Oh.
However, there are income limits for Roth IRA contributions,
Right.
so it's not an option for everyone.
So how do we decide between traditional and Roth?
It comes down to your current income level
Okay.
and your expectations for future tax rates. If you're currently in a lower tax bracket, but expect to be in a higher one in retirement,
Mm-hmm.
a Roth IRA might be the better choice.
I see.
Conversely, if you're in a high tax bracket now and expect to be in a lower one later,
Yeah.
a traditional IRA might make more sense.
So it's a bit of a balancing act,
It is.
weighing the tax benefits today versus the potential savings in the future.
Exactly. And regardless of which type of account you choose,
Yeah.
the most important thing is to start investing early and consistently.
That seems to be a common theme.
It really is key.
Yeah.
The earlier you start,
Yeah.
the more time your money has to grow,
Right.
the more you benefit from compounding.
Compounding, that's where the real magic happens.
It really is.
It's like that snowball rolling downhill.
I like that visual.
Yeah, it's gathering more snow and momentum as it goes.
That's a great way to think about it.
Yeah.
Even small, consistent contributions can grow into a substantial nest egg over time.
All right, we've covered a lot of ground already. From the power of FU money to index funds and tax-advantaged accounts.
Yeah.
But before we move on, I want to share a story from J.L. Collins' book.
Okay.
It really blew my mind.
Okay, I'm listening.
He talks about meeting a guy named Muck.
Muck.
Yeah, Muck.
Okay.
Who owned a hotel in Tahiti.
Wait, what? A hotel in Tahiti?
Yeah.
Tell me more.
This guy, Muck, had absolutely no prior experience
Wow.
in hospitality or construction.
Okay.
But he ended up owning this successful hotel in Paradise.
How did that even happen?
He basically stumbled into it.
Okay.
He and two friends,
Hmm.
fresh out of university,
Yeah.
bought a pineapple plantation in Tahiti sight unseen.
Oh, wow.
They were city kids
Okay.
with zero knowledge of agriculture.
Oh, boy.
It kind of was a recipe for disaster.
It sounds like it.
They went broke pretty quickly.
Oh, no.
But then a local bank approached them with a proposition.
A proposition.
There was this half-constructed hotel down the hill
Okay.
from their failed pineapple plantation, and the bank wanted them to finish it.
Wait, they had no experience in construction either.
Nope, not a single bit.
Wow.
But they were Americans,
Right.
and back then, Americans had a reputation for getting things done.
I see.
So they took a chance,
Okay.
rolled up their sleeves, and figured it out as they went along.
Wow.
They finished the hotel.
Good for them.
They got it operating profitably.
Wow.
And eventually they went on to build more hotels.
Ollie.
Talk about a wild ride.
That's incredible.
It speaks to the power of taking risks.
Yeah.
Even when you don't have all the answers or experience.
Sometimes you just have to jump and build your wings on the way down.
Exactly. It's a reminder that sometimes the most unexpected opportunities come from what seem like failures or setbacks.
That's very true.
It also highlights the importance of stepping outside your comfort zone
Right.
and embracing those challenges.
Absolutely.
I think that's a good place to pause for now.
Indeed. Much to unpack there.
Welcome back to our deep dive into the simple path to wealth.
Glad to be back.
Before we jump into the next layer of J.L. Collins' wisdom,
Yeah.
that story about Moke really got me thinking.
Yeah.
It just shows that even with setbacks, a willingness to adapt and learn can lead to unexpected success.
Absolutely.
But let's get back to building our own financial fortress.
Okay.
We've talked about index funds like VTSAX and VBTLX as those core components.
Right.
But J.L. Collins also mentions target retirement funds,
Yes.
or TRFs.
Yeah.
What's the deal with those?
Well, TRFs are designed to simplify investing,
Okay,
especially for those who prefer a hands-off approach.
I see.
They're all-in-one solutions that automatically adjust your asset allocation
Okay,
as you get closer to retirement.
I see.
So you choose a fund based on your target retirement year,
Right.
and the fund managers handle the rest,
Okay.
gradually shifting from stocks to bonds as you age.
So it's like a set it and forget it approach, which could be appealing to a lot of people who are busy or maybe feel overwhelmed by investment choices.
Yeah, absolutely.
But wouldn't you sacrifice some control with TRFs?
That's the trade-off.
Yeah.
With TRFs, you're essentially buying a basket of funds,
Okay.
predetermined by the fund manager.
Right.
You can't pick and choose individual holdings
I see.
or adjust the allocation beyond the fund's preset glide path.
That makes sense.
Yeah.
TRS might be a good starting point
Yeah, I think so.
for someone new to investing or who prefers simplicity.
Right.
But for those who want more control
Yeah.
or have specific investment goals,
Wow.
sticking with individual index funds like VTSAX and VBTLX
Yeah.
might be the better strategy.
I agree.
Now, what about those of us who can't invest in Vanguard funds directly?
Right.
Maybe our employer's plan doesn't offer those options. Or we're looking for choices outside of Vanguard.
You're in luck. Thanks to competition from Vanguard, most major mutual fund companies now offer low-cost index funds
Okay.
that track the same indexes as VTSAX and VBTLX.
So essentially, we're looking for clones of VTSAX and VBTLX from different fund families.
Here's a pro tip.
Okay.
Pay close attention to those expense ratios.
Okay.
Even a fraction of a percent
Yeah.
can make a big difference in your returns.
Right.
Every dollar you save on fees
Yeah.
is a dollar that stays invested and working for you.
Minimize those fees.
For sure.
J.L. Collins is clearly a Vanguard enthusiast.
He is.
He even says Vanguard is the only company
Yeah.
that truly puts its clients' interests
This
first.
is a bold statement.
It is. What makes him so confident?
It all comes down to Vanguard's unique ownership structure.
Okay.
Unlike other investment companies,
Uh-huh.
which are privately owned or publicly traded,
Yeah.
Vanguard is owned by its fund investors.
Wait, so the investors actually own the company?
It's like a giant cooperative
Wow.
because the investors are the owners. Yeah.
There's no inherent conflict of interest.
I see.
The profits go back to the investors where they belong.
That's a compelling argument.
I think so.
It seems like a built-in alignment of incentives.
Yeah.
Okay, I'm convinced.
Yeah.
Vanguard seems like the winner.
Uh-huh.
But let's switch gears and dive into tax-advantaged accounts.
Okay.
You mentioned 401ks, IRAs, and Roth IRAs earlier.
Yes.
Can you break those down a bit more?
Absolutely. Let's start with 401k.
Okay.
Those employer-sponsored plans.
Right.
These plans allow you to contribute pre-tax dollars,
Okay.
which means an immediate tax break.
Yeah.
Investments grow tax-deferred, and you only pay taxes when you withdraw in retirement.
So it's like a tax-sheltered investment account.
Precisely.
Your money grows more efficiently
Right.
since you're not paying taxes on those gains along the way.
Exactly.
And many employers offer matching contributions, right?
Yes, it's like free money.
Free money is always good.
It is.
So contribute enough to get that full match if you can.
Absolutely.
Now, what about IRAs and Roth IRAs?
Well, IRAs offer more investment flexibility
Okay.
compared to 401ks,
I see.
which are usually limited to funds chosen by your employer.
Right.
So with an IRA, you have more control
Yeah.
over your investment choices.
Which can be a big advantage
You can.
for tailoring your portfolio
Right.
to your specific goals and risk tolerance.
Exactly. And there are two main types, traditional and Roth.
Okay, we touched on this earlier.
Yes,
Can you remind us of the key difference?
of course.
They both offer tax advantages, but in different ways.
You're right.
Yeah.
With a traditional IRA, your contributions are tax deductible,
Right.
meaning you lower your taxable income right now.
I see.
Your earnings grow tax deferred.
Okay.
You only pay taxes when you withdraw the money in retirement.
Got it.
Roth IRAs work a little differently.
Okay.
Contributions aren't tax deductible,
Yeah.
but your earnings grow tax-free.
Okay.
And qualified withdrawals in retirement are also tax-free. So with a traditional IRA, you're deferring taxes until retirement.
Right.
And with a Roth, you're prepaying them now for tax-free withdrawals later.
That's a great summary.
But how do you choose between the two?
It depends on your current income and your expectations for future tax rates.
Okay.
If you're in a low tax bracket now, but expect to be in a higher one in retirement,
Yeah.
a Roth IRA might be the better choice.
Okay.
If you're in a high tax bracket now, but expect to be in a lower one later,
Yeah.
a traditional IRA might make more sense.
So it requires some forecasting
It does.
to see which option might be more advantageous in the long run.
You're not wrong.
Yeah.
But even if you're unsure which IRA is best,
Mm-hmm.
the important thing is to start investing early
Yeah.
and consistently.
Right.
The sooner the better.
Right. And don't forget compounding.
Of course, those early contributions have the longest time to grow.
We've covered 401ks and IRAs.
We have.
But what about HSAs?
Ah, yes, HSAs.
They seem a bit more specialized, right?
They are a bit more niche.
Okay.
Designed for people with high deductible health insurance plans.
Okay.
HSAs allow you to set aside pre-tax money for qualified medical expenses.
Okay.
And any unused funds roll over year to year, growing tax-free.
So it's like a healthcare savings account
Yeah.
with some pretty sweet tax benefits.
It's a triple win.
Okay.
You get a tax deduction for contributions,
Yeah.
earnings grow tax-free,
Uh,
and withdrawals for qualified medical expenses are also tax-free.
that's awesome.
Yeah.
We've explored different investment options, tax-advantaged accounts, the importance of starting early and staying consistent.
The foundation.
Now let's fast forward to retirement.
Okay.
We've all heard of the 4% rule,
Ah, yes.
but how does it actually work?
Well, the 4% rule is a guideline
Okay.
that suggests you can safely withdraw 4% of your portfolio each year
Okay.
without running out of money.
Okay.
It's based on the Trinity study,
Right.
which analyzed historical market data
Yeah.
to determine sustainable withdrawal rates.
I see.
But it's important to remember,
Yeah.
the 4% rule is a starting point,
Okay.
not set in stone.
More like a rule of thumb than a
Exactly.
guaranteed formula.
While it can be helpful,
Yeah.
J.L. Collins cautions against treating it as a rigid rule.
Okay.
He emphasizes flexibility,
Right.
adapting your rate based on your circumstances, market conditions, and life expectancy.
Makes sense that a one-size-fits-all approach wouldn't work for everyone.
No, it wouldn't.
We all have different needs and goals.
And life expectancies.
What specific strategies does J.L. Collins recommend?
He suggests a layered approach.
Okay.
First, consider any non-investment income you might have.
Okay.
This could be from a part-time job, rental income, or even Social Security.
Whatever it is, use that money first.
Exactly.
This allows your investment to continue growing,
Right.
providing that solid foundation.
Precisely.
So prioritize that non-investment income first.
Yes.
What's the next layer?
If you have any leftover investments
Yeah.
from your pre-retirement days
Yeah.
that aren't aligned with the simple path,
Okay.
now's the time to sell them.
What J.L. Collins refers to as the cats and dogs.
Exactly. The investments that aren't performing well
Yeah.
or are overly complicated.
Great. Get rid of those.
Yes.
Use the proceeds to fund retirement.
Exactly.
So we've tapped into non-investment income and cleaned up our portfolio.
Right.
What's next?
Once those sources are exhausted,
Yeah.
we start dipping into our tax-advantaged accounts.
Okay.
But strategically,
Okay, how so?
start with your taxable accounts.
Okay.
They're generally less tax efficient
Okay.
than those tax-advantaged accounts like IRAs and 401ks.
Why prioritize the taxable accounts first?
Because withdrawals from taxable accounts are taxed at your ordinary income tax rate,
Okay.
which could be lower than the rates applied to withdrawals from traditional IRAs and 401ks.
So it's about minimizing the tax hit early on.
Exactly.
And what about those Roth IRAs?
Those are the last accounts you tap into.
Okay.
Ideally,
Why?
because qualified withdrawals from Roth IRAs are tax-free.
Right. You've already paid taxes on those contributions.
You got it.
Save the best for last.
Exactly.
But what about RMDs?
Ah, yes. Required minimum distributions.
They can throw a wrench in things, can't they?
They can be tricky,
Yeah.
but J.L. Collins offers some strategies.
Okay.
He suggests using RMDs,
Yeah.
those mandatory withdrawals from your traditional IRAs and 401ks,
Right.
to fund your retirement spending.
Okay.
This allows your Roth IRA and taxable accounts to stay untouched,
Yeah.
giving them more time to grow.
That's a smart approach.
It is.
But what if those RMDs push you into a higher tax bracket?
That's a valid concern.
Yeah.
If you find yourself in that situation,
Mm-hmm.
strategic Roth conversions can be valuable.
Okay.
J.L. Collins suggests converting a portion of your traditional IRA to a Roth each year,
Okay.
taking advantage of years when your income is lower and you're in a lower tax bracket.
So being proactive and planning ahead
Precisely.
to minimize your tax liability throughout retirement,
Exactly.
this is incredibly helpful information.
I'm glad to hear that.
We've covered so much,
It's a lot.
from index funds to retirement withdrawals and tax management.
It is.
It's a lot to digest.
Take your time.
What are some key takeaways our listeners should focus on?
First, building wealth is a marathon, not a sprint.
Right.
It requires patience, discipline,
Yeah.
and a commitment to stay the course,
Right.
even when things get tough.
It's about trusting the process and not getting distracted
Right.
by get-rich-quick schemes or market hype.
It's a journey.
Exactly.
Second, keep it simple.
Okay.
You don't need a complicated portfolio or a fancy financial advisor.
Keep it simple, stupid.
Exactly. Stick with low-cost index funds. Use those tax-advantaged accounts.
Yeah.
Keep your strategy straightforward.
And third, never underestimate the power of financial literacy.
It's so important.
Invest time in learning,
Absolutely.
understanding different financial instruments,
Right, yeah.
becoming an informed decision maker.
Exactly.
The more you know, the better equipped you'll be.
It's about taking ownership
Yeah.
of your financial future.
Now, before we wrap up this part,
Yeah.
I want to touch on Social Security.
Okay.
It's often shrouded in misinformation and uncertainty.
It is.
What's J.L. Collins' perspective?
He acknowledges that Social Security can be valuable,
Okay.
especially for those who haven't saved enough.
Right.
But he advocates for financial independence as the goal,
Okay.
encouraging people to plan as if Social Security won't be there.
So hope for the best, but prepare for the worst.
Exactly.
He points out that the future of Social Security is uncertain,
Yeah. Relying solely on government benefits is risky.
so best to view it as a potential bonus rather than a core pillar.
Exactly.
While the system has challenges, it's unlikely to disappear completely,
Right.
but it's wise to plan for self-sufficiency.
I agree.
So J.L. Collins recommends planning as if Social Security won't be there.
That's right.
He emphasizes building a solid foundation
Yes.
through saving, investing, and managing debt.
Okay, so we've done all that,
Mhm.
and we're ready to think about claiming those Social Security benefits.
Okay.
What factors should we consider?
The key is understanding the trade-offs.
Okay.
The earlier you claim, the smaller your monthly checks.
Well, I see.
The longer you delay, the larger your check.
Up to age 70, right?
Yeah,
So instant gratification versus delayed gratification.
exactly. The decision depends on your circumstances, health, life expectancy, and financial needs.
Seems like a personalized decision
It is.
with no one-size-fits-all answer.
You're right.
J.L. Collins offers a simple guideline.
Okay.
If you're in good health and don't need the money right away,
Yeah.
delay benefits as long as possible.
To maximize those lifetime payouts.
Delaying gratification for the win.
Right.
But I imagine there are situations where claiming early might make sense. Maybe you have health concerns or need the income for essential expenses.
Right. It's
Yeah.
about weighing the pros and cons.
Exactly.
Making the best decision for your situation.
Absolutely.
Okay, I think that's a good place to pause for now.
Okay.
We've explored Social Security, the importance of financial independence,
Yeah.
the power of making informed decisions
Right.
based on our individual needs and goals.
Indeed. A lot to consider.
In the final part,
Yeah.
we'll wrap up our exploration of the simple path to wealth,
Sounds good.
highlighting those core principles
Yes.
that can help us achieve financial freedom
Absolutely.
and create a more fulfilling life.
It's the ultimate goal.
Stay tuned for the grand finale. Welcome back to the final part of our deep dive into the simple path to wealth.
It's been quite a journey.
It has. We've explored a lot of ground,
We have.
from the power of FU money
Yeah.
to the complexities of Social Security.
A lot to unpack.
Now let's distill it all down to the core principles that can really transform your financial life.
It's about seeing the bigger picture.
Right.
J.L. Collins' approach is great.
Yeah.
Because it's not just about accumulating wealth.
It's about aligning your financial choices with your values,
Exactly.
with your passions and your life goals.
He often talks about money as a tool.
Okay.
Like any tool, it can be used for good or for ill.
It's up to us to decide how we want to wield that tool.
Do we chase material things?
Yeah.
Or do we use it to craft a life of freedom and meaning?
A life of impact.
Exactly.
He shares a great story
Oh,
about a charitable auction
okay.
he and his wife participated in.
Yeah.
They won this gourmet dinner for 10
Okay.
at a fancy restaurant
Nice.
and decided to gift it to the teachers
Wow.
at their daughter's Catholic school.
That's a really nice gesture.
The chef at the restaurant heard about it
Okay.
and offered to expand the dinner
Wow.
to include all 15 teachers.
That's amazing.
Another bidder even chipped in to cover the wine. That's so generous.
What a beautiful example
It is.
of generosity and community.
Yeah,
Money can be a conduit for joy and kindness.
absolutely.
It highlights that true wealth
Yeah.
is about so much more than just your bank balance.
Right.
It's about using your resources to create a life
Yeah.
that is rich in experiences and
Mm.
relationships and purpose.
Let's bring it back to those core principles
Okay.
that J.L. Collins emphasizes throughout the book.
They are simple but powerful.
Spend less than you earn.
Yeah.
Invest the surplus wisely.
Avoid debt,
And stay the course.
even when things get tough.
That's key.
Those principles are about building sustainable habits,
Right.
not getting distracted by those get-rich-quick schemes.
Or market hype.
It's a marathon, not a sprint.
Exactly.
It's a journey, not a destination.
There will be ups and downs, market fluctuations, unexpected challenges.
But by sticking with the plan,
Yeah.
you can achieve financial freedom,
It's about building resilience.
not letting fear sabotage your progress.
J.L. Collins also stresses continuous learning.
So important.
Seek out knowledge. Learn from others.
Ask questions.
There's a wealth of information available.
There is.
Tap into those resources.
Books, podcasts, blogs, online communities.
Don't stop expanding your financial literacy.
It's about taking ownership
Yes.
of your financial future.
As we wrap up this deep dive,
Yeah,
I want to leave you with a final thought-provoking question
Okay.
from J.L. Collins.
I'm listening.
He asks, what would financial freedom look like for you? And what one step can you take today to move closer to that vision?
It's a powerful question.
It is.
It makes you think.
It invites us to define our own version of success
Right.
and take action.
We hope this deep dive has been valuable. We've given you some practical strategies.
This renewed sense of empowerment
For sure.
when it comes to your finances.
It's a journey worth taking.
Thanks for joining us on this exploration of the simple path to wealth.
It's been a pleasure.
Until next time, keep diving deep.